Hi stock investors, JJ here. Welcome back. Well, Aswath Damodaran again today. It's become a bit of a tradition on this channel. He's got more to say about Nvidia and the overall stock market. He's always got interesting things to say. The Dean of Valuation, they call him, from NYU, the professor at NYU. Let's see what he's got to say this time about Nvidia and what may be a better buy than Nvidia right now for him anyway.
Wall Street's Dean of Valuation, Professor of Finance at the NYU School of Business. Always good to see you. So Nvidia looks stretched. Does that mean you sell it?
I think it's a dangerous game to play. If you don't own it, the only way you can sell it is to short the stock, and that's a recipe for disaster, especially leading into an earnings report. And the way to think about Nvidia is, are you a trader? In which case, you buy at a low price and sell at a high price, and Nvidia might be the game you want to play. Are you an investor? Where you're buying based on earnings and cash flows. Nvidia is an amazing company, great growth, amazing cash flows, superb margins, but you're paying a premium price even given all of those pluses. So I think you've got to be honest with yourself about the game you came to play.
Okay, interesting. There a lot there already. He talks about being trader versus an investor. He doesn't call himself a value investor. He's more of a growth investor. I've heard him talk about that before. So he said you've got to decide whether you're a trader or an investor. And if you're a trader, is this a good time to buy it? There may be momentum there if you're a momentum trader. He talks about shorting, that it's a dangerous game to play. It's always a dangerous game to play. Is it going to go down? We've seen it go down. I think it went down about 27, 28% before it bounced again. So with shorting, you got to get the timing right. You can lose a lot of money. So he's obviously not in favor of that, and neither is Warren Buffett.
So and broaden that out for the whole market. You make an interesting point here. You say hubris is the greatest sin in investing, the excessive pride. And when people use the word bubble, it tends to be a sign of hubris. Explain.
I think that when you use the word bubble, you're essentially arguing that the rest of the market has lost its mind. And that, to begin with, is a sign of an ego that's out of control.
He's got some good catchphrases, some good lines here. I guess it's because he's a professor. He talks a lot to the students. Is calling out a bubble hubris? Is it an ego out of control? We know people who have called out bubbles. Jeremy Grantham's one of those. It seems to be going on and on. He has got the timing wrong. He says we're in the biggest bubble in history. There have been others too who've called out this bubble, but you can call a bubble and short it and get really caught out by that. I've seen people do that. I think Everything Money's Paul Gabriel did that with Nvidia and gave up on it. He lost millions in it, and that's what can happen when you short a stock like Nvidia, which either in a bubble or not, or a stretched valuation, it can go on. If it does get exuberant, the market, if it gets crazy, it can go on and on. As those of us who remember the dot-com bubble, that it can go on and on for much longer than you think.
When you think something is overvalued, all it means is you think it's overvalued. It doesn't mean it's overvalued. It doesn't mean you have the truth. You have your truth and you got to act on it, but the rest of the world has their own truth. So my view on investing is make your own judgments, but don't pass judgment on other people buying or selling stocks because you don't like what they pay.
So in your judgment, among some of the mega cap stocks, what's a better deal right now?
I think Amazon is a better deal than Nvidia as an investor. If you wanted to go with the mega tech, I think Amazon is a better buy than Nvidia.
Okay, better buy than Nvidia is Amazon. Let's look at the comparison here. I've got this up. This is a comparison just for year to date if you had been invested in either. It depends where you buy, of course. He's saying right now when you buy, he's saying Amazon for him is a better buy than Nvidia. But if we go back year to date, we can see that Nvidia is up 160, nearly 7%. Just year to date, Amazon's only 20. If we go back 1 year, we can see that Amazon's up 33.73. And going back 5 years, which is probably a better way to look at it, is 3,000% for Nvidia. It's really different. So I can see why he thinks that out of the mega cap stocks that Amazon is a better buy now. He bought Tesla earlier on this year as well. I don't think he says that here, but he has said that.
But I think given the earnings and the cash flows, if I had to buy a stock now and you force me to buy a big tech, I would rather own Amazon or buy Amazon than buy Nvidia right now.
So if you're getting value out of this video so far, by the way, please remember to smash that like button to help the algorithm to spread it to more people. I really appreciate that. Thanks.
How are you valuing small cap stocks, which have performed not as well as mega cap names that we've been discussing so far? And when should investors, not traders, but investors, start charting out narratives that make sense to them where those are concerned?
I think a lot of people believe in mean reversion, which is they assume that if small caps have underperformed for a while, they've got to come back. I'm going to posit that there's been an economic shift, that the way the economy is structured is you have more winner-take-all businesses, which effectively put smaller companies at a disadvantage. So one reason why I think small cap stocks have underperformed larger cap stocks, not just over the last few months, but over the last decade, is because the market seems to have come to that realization as well. It might have overcorrected, and there might be some kind of a reversion back at least to a more normal pricing. But I'm going to argue that those people who expect the old small cap premium, small caps historically have delivered higher returns than large caps to come back, might be barking up the wrong tree.
Okay, that's interesting talk of small caps there, because I have done videos on this channel about small caps. Tom Lee from Fundstrat thinks that small cap index, the Russell 2000, as we see here on screen, is going to go up 50% for the year and 40% up from here, because that's what it'll take. He still thinks that. So when mean reversion, let's have a look at the index. We can see here the Russell 2000 is not doing incredibly well, but it's up so far for the last 6 months, 8.81 versus the S&P 500, 12.83 in year to date. So far, the S&P and the NASDAQ are outperforming it, but it did have a jump here. Now, from my point of view, I don't necessarily agree with what he's saying here. It might be so, it might not be. And I think it depends on the companies. He just talked about the index, but it depends on the companies themselves. I do have small caps, and they're doing pretty well this year. They're about 30% year to date. I do talk about that on my Patreon here in the weekly investing updates. I talk about that quite a lot, small caps. And stock analysis secret sauce over there, by the way, if you want to join us over there, I'm doing regular modules there, building up those are 7 at the moment. And those weekly investing updates, you could join for a month and go back there and binge watch all those if you want to. Let's get back to Aswath Damodaran and see what else he's got to say. That was interesting about the mega caps and then the small caps.
I mean, it's an interesting point when you think about what's happened to salaries, to incomes in our society, right? The inequality, the wealthy have tended to get wealthier, and the working class hasn't fared so well. If you looked at income the same way you looked at stocks, you would expect, well, eventually, the working class has to catch up, and it doesn't work that way.
Not quite, and especially in business, because if your economy is structured with 3 or 4 winners in every sector, what is it in the economy that's going to force the smaller companies or allow the smaller companies to catch up? It just doesn't work for them.
I think it depends on the company. It stands to reason that a lot of the big companies started as small cap companies, even if they didn't go public until they were bigger. They just started smaller companies. So in theory, some of the best smaller cap companies with a long runway for growth will end up being the bigger companies, and they will do well through different economic conditions, through different interest rates. They'll just do well, but very small percentage. But in general, as Warren Buffett have said before, and Charlie Munger and others, the best companies out there is just a tiny percentage anyway. If you're a growth investor or a value investor, a compounding investor wanting to find those long-term compounders, you're looking for those best companies, right?
Now, what about playing the sector game? There are certain historical tendencies during cycles. Is that similarly dangerous to expect that because something is happening in the macro environment, certain sectors are a better value or worse?
I think in hindsight, there's always sector rotation. In hindsight, we can always say, if only I'd done that. I've looked at sector investing over time, and if you can rotate sectors well, all the more power to you. I just don't have that capacity. I find myself constantly second-guessing myself. So I think you can look at sectors, and I think you can make some judgments. Right now, for instance, if you think interest rates are going to continue to fall, and they have already, then you're going to see utilities benefit from the fact that rates are lower. So you can make a macro bet with sectors, but beyond that, there's not much you can do.
I agree with him there. I agree with him wholeheartedly. Chasing sector rotation there. A lot of people do that. I see people talking about commodities and different sectors rotating from one to the other, depending on what's going to do well over the next decade or 5 years. I find that I can't do that either. I'm not looking for that. I'm looking for the good companies that are going to compound for a long time, preferably smaller companies. But, rotation to sector and sector, as he said, he can't do that, but all power to you if you can do that. Now, I want to tell you that about this offer I have from ShareSite for my viewers, my community here. You can sign up for free for ShareSite, by the way. It's a portfolio tracking and reporting tool that 400,000 investors around the world trust, including me. I wouldn't recommend anything that I don't use myself. And the special offer here, as I said, you can sign up for free if you want to. The premium features, the special offer on that, but go and check it out. I'll leave a link in the description for this to the landing page. There's a video here too if you want to check that out. I'm going to put on screen a link to a YouTube video that you might like to watch now, based on what the algorithm thinks you should watch. It's usually pretty good. Thanks for joining me, and I'll see you in the next one.